From Jay's perspective in studying the micro and macro data in this sector, does he think the current industrial slowdown could be as large as the global industrial recession from 2015 that Keith has talked about before?
We don't see that in the data yet. I think some data out of China is very concerning. Obviously, the Chinese stock market, it doesn't portend great things. And to some extent, the industrial economy is organized, a certain portion of the industrial economy is organized around feeding the Chinese fixed asset investment bubble. So, fixed asset investment boom, however you want to think of it. I don't want to get into a discussion about its sustainability, but so when China does slow down, that can have broader implications. Historically, they've stimulated and haven't had really big impacts like that. But it is one area of vulnerability. Mostly, we don't. I think there was this. The way I view it is that you had this tax reform thing that went through that increases after-tax returns, but also increases the after-tax cost of equipment, right? Because I'm expensing things at a lower tax rate. So I think there was this expectation in the sector that everybody was going to run out and buy a backhoe for Christmas and expense it, and it's going to get their taxes down, and that wasn't really the way it played out. Mostly equipment was already expensed in the old tax code because you had accelerated depreciation and first-year makers for most things, and you had a higher tax rate. So there really wasn't a huge, and so the shield of that previous depreciation was very high. So I think you saw the stocks respond very favorably. You saw a tax reform pre-buy of certain pieces of equipment where people buying a box of rags was cheaper on December 31st, 2017 than it was after tax on January 1st, 2018, because suddenly the tax shield was higher. So people rushed to spend money in the end of 2017. That carries over into the first quarter as you get a restock. And you just generally have a pretty good economy during that period. And now you're facing much harder comps, right, from the pre-buy and things like that. That's going to be important for things like the distributors. And then, from there, I think it really does come down to, what's visible. Even in Quad 4 and 1Q, the disinflationary part is, equally strong in the fourth quarter, but you see the growth component be a little less bad sequentially. Does that hold? We're data dependent. I think that'd be fair from a macro view, but we don't see, there are always pockets of specific weakness. So one thing we do in the sector is I think we really don't look at the totality of the industrial environment that often, but we'll look specifically at the fleet age, the fleet demographics of specific pieces of equipment. Because the reality is that Oshkosh makes fire engines, and fire engines, have their own thing going on, right? Like they have the 9/11 first responder funding. You get a whole cohort of 2004 fire trucks, and they kind of have a 15-year life. So they get replaced in 2019, and they probably get replaced mostly regardless of what's happening in the economy. So we try and keep it specific to industries and equipment categories and fleets rather than look at. So there are specific fleets that look terrible, but for the most part. We see a deceleration in growth, a disinflationary environment. You could have an ag blow up if you saw ag land prices, which are, a NASDAQ scale bubble that started in 2001 and proceeded through maybe 2014, 15. That started to roll over. If that continued, could you see a real blow up in the ag space? Yeah, sure. But, we haven't seen it yet, and we don't see a ton of really dramatic downside like we saw in 2016. But it can creep up on you, But we would try and stay data dependent and not go further than we have to.